I'm walking down the street, enjoying the sights and sounds of the city, when I start thinking about my own investment portfolio. You know, the one you've been saving up for years to make a fortune? Well, let me tell you, it's not enough. We need to diversify. Now, some people might think that diversification is just a bunch of random asset classes thrown together and hoping for the best. But I'm here to tell you that's a recipe for disaster. Think about it like a sports team. You've got your star player who's always performing at their best, but then suddenly they're injured, or they start to decline in performance. The rest of the team is now holding on to him because he's a key part of their lineup. But what if you had a team with multiple players who were all performing well? You'd be more confident that your entire team would work together and win, right? That's exactly how I feel about my investment portfolio. Instead of relying on just one or two asset classes to grow it, I've diversified across a range of different stocks, bonds, real estate, and commodities. Let's start with the basics. Stocks are like individual players on the team. They all have their own strengths and weaknesses, but together they can create a winning combination. Think about Apple, for example. One stock might be high growth in one area, while another is more stable in another. But when you combine them both, it creates a powerful synergy. Now, bonds are like the reliable backup player on your team. They provide stability and consistency, even if one of your other players isn't performing as well as they used to. Government bonds, for instance, offer a low-risk investment option that's easy to understand and maintain. They're like the steady, dependable cousin who always shows up on time. Real estate is like having a team with multiple specialized skills. You've got your real estate agent who knows the market inside out, your contractor who can build anything you want, and your financial advisor who can help you make smart decisions about your portfolio. Together, they create a powerful synergy that can help you achieve your goals. And then there's commodities like oil or gold. These are like the luxury items on your team. They're high-end and hard to find, but when you have multiple players in this position, it creates a strong foundation for growth. But diversification isn't just about having individual asset classes that work well together. It's also about balancing them out so that no single one dominates the portfolio. Think about it like a seesaw. As long as both sides are balanced and working together, it stays steady. Now, I know some people might say that diversification is too complicated or too expensive to implement. But trust me, it's worth it in the long run. When you have a diversified portfolio, you're not just protecting your assets from market volatility, you're also building wealth over time. For example, let's say you invest $10,000 in Apple stock and another $5,000 in Amazon stock. If Apple's stock price increases by 20%, it might jump to $100 per share. But if the entire portfolio goes up or down, your individual investments are at risk. But with a diversified portfolio like this, even if one of them performs poorly, the other ones will still be performing well. And then there's the power of compounding. When you invest in multiple assets that grow over time, it creates a snowball effect that can help you achieve your financial goals faster than you would if you were to invest in just one thing. But diversification isn't just about investing in individual assets, it's also about managing risk. Think about it like a roller coaster ride. When the coast is smooth and everything is going well, you're riding high. But when things start to go wrong, the roller coaster drops down and you're facing a bumpy ride. That's where diversification comes in handy. By spreading your investments across different asset classes and industries, you can create a more resilient portfolio that can weather any storm. Now, I know some people might be thinking, but what about all the risk involved? Won't my portfolio go down if one of these assets doesn't perform well? And to that, I say yes, there is always some level of risk involved in investing. But here's the thing, diversification isn't just about minimizing risk, it's also about maximizing returns. Think about it like a game of poker. You're not trying to win the pot by betting all your chips on one hand. You want to spread your bets across different hands so that if one hand loses, another hand will still be performing well. That's what diversification is all about, spreading risk across multiple assets and industries, so that even if one thing doesn't go as planned, others can help bail you out. Now, I know some people might be thinking, but how do I implement a diversified portfolio? What are the steps I need to take? Well, let me tell you, it's not rocket science. You just need to start by identifying your financial goals and risk tolerance, then create an investment plan that balances those two things. You'll also want to consider your current assets and liabilities, as well as any tax implications or fees associated with investing in different asset classes. And finally, you'll want to set up a regular investment schedule so that you can take advantage of dollar cost averaging, which means investing a fixed amount of money at regular intervals, regardless of the market's performance. But here's the thing, diversification is not just about technical stuff, it's also about understanding yourself and your financial situation. You need to be willing to listen to your gut feeling and adjust your investment plan accordingly. For example, let's say you're a young professional with a variable income, which means you can't rely on a steady stream of investments. In that case, you might want to consider investing in higher-risk assets like stocks or bonds, while still spreading out your investments across different asset classes and industries. And then there's the power of tax optimization. When it comes to taxes, diversification can be a powerful tool. By spreading your investments across different asset classes, you can create a more efficient investment plan that minimizes your tax liability. Now, I know some people might be thinking, but what about all the research and analysis required to build a diversified portfolio? And to that, I say yes, it's no secret that building a diversified portfolio requires hard work and dedication. But here's the thing, diversification is not just about doing more research, it's also about knowing how to use the information you do have effectively. For example, let's say you're trying to determine which asset classes are best for your portfolio. You might start by conducting a thorough analysis of different assets and industries, using data from reputable sources like Morningstar or Yahoo Finance. But then you'll want to consider your own financial situation, risk tolerance, and investment goals. You'll also need to think about how diversification can be applied to specific asset classes. For instance, if you're considering investing in real estate, you might want to focus on areas with lower debt-to-income ratios or higher rental yields. And finally, you'll want to stay up to date with the latest market trends and news, which means regularly reviewing your portfolio and adjusting it as needed to ensure that it remains aligned with your financial goals and risk tolerance. Now, I know some people might be thinking, but what about all the fees associated with investing in different asset classes? And to that, I say yes, there are certainly fees involved. But here's the thing, diversification is not just about minimizing costs, it's also about understanding how those costs can add up over time. For example, let's say you're investing in a high-cost mutual fund that charges 1% management fees and an additional 0.5% trading fees per year. Over the course of a decade, these fees could add up to tens or even hundreds of thousands of dollars. But by diversifying your portfolio across different asset classes, you can spread those costs out over multiple years, which means you'll be less likely to pay them in full. Now, I know some people might be thinking, but what about all the benefits of having a diversified portfolio? And to that, I say yes, there are many. For one thing, diversification can help you achieve your financial goals faster than if you were to invest in just one thing. It can also provide peace of mind and reduce stress, knowing that your investments are spread out across different asset classes. And finally, it can even add value to your wealth over time. When you have a diversified portfolio, you're creating multiple layers of protection against market volatility, inflation, or economic downturns. You're also building a foundation for long-term growth and success. Now, I know some people might be thinking, but what about the risks involved in diversification? And to that, I say yes, there are certainly risks involved. But here's the thing, these risks can be managed by spreading your investments across different asset classes and industries. Think of it like a game of chess, you're not trying to win the game by making a single move. You want to create multiple layers of protection and counter threats that will help you stay ahead of your opponent. That's what diversification is all about, creating multiple layers of protection that can help you achieve your financial goals. Now, I know some people might be thinking, but how do I implement a diversified portfolio in real life? And to that, I say yes, it's not rocket science. You just need to start by taking small steps towards diversification. Maybe it means starting with 1 or 2 assets and gradually expanding your portfolio over time. Or maybe it means setting up automatic investments so that you can take advantage of dollar cost averaging and ride out market fluctuations. Or maybe it means considering tax optimization strategies, like transferring assets into more efficient tax-advantaged vehicles. The key is to start small and be consistent, because the biggest risk in investing is not taking action at all. So, whether you're a seasoned investor or just starting out, I encourage you to take control of your portfolio by diversifying across different asset classes and industries. This is not financial advice. Please do your own research. This information is AI generated. Use it at your own risk.